Next module we have is on inventory. We'll be discussing types of inventories, goods and materials to be included in your inventory valuation, periodic versus perpetual system, primary inventory cost flow assumptions, gross profit method, and finally, firm purchase commitments. We're going to discuss each one of them in detail. So let's get started. First of all, we all know inventories are goods that a business holds for resale or for production, and these items we need on a regular basis. So these items needs to be counted, valued and recorded. So there are four main types of inventories. First is the retail inventory. That's the inventory we purchase to resell in the same form. We don't do any work on that, like a clothing store inventory of let's say shirts. So they are purchased from the supplier and then we will sell directly to our customers. Raw materials inventory, this clearly is the inventory that would be used in the production process to create other products, like maybe we purchase wood or maybe metal that we will use in manufacturing of the furniture. Work in process inventory that is in production but not yet completed, like a car that is half assembled and still it's on the production line. And finally, of course, finished goods inventory, this inventory that has been completed. I mean, production process is over and now it's ready for, say, let's say you're talking about car assembly. So a fully assembled and packaged car ready for delivery to the customer is what you call the finished goods inventory. Goods and materials to be included in inventory. First of all, you need to be very clear. Whatever you see in your warehouse, that might be included as a part of your inventory. But there are certain items which are not there in the warehouse, but they need to be included. So in general, goods and materials in which a company holds legal title should be included in its inventory. That's a simple idea. So the legal title often passes along with the possession of goods sometimes, but there are certain special cases that we need to see. Let us see these one by one. Goods in transit. Goods in transit means the items that are being shipped from seller to the buyer, and the title passes depends upon the agreement between two parties. Like agreement, if it's based upon FOB shipping point, it means first of all FOB means free on board. So if the agreement between two parties is FOB shipping point, in this case the title passes to the buyer when the seller ships the goods. Means when the goods are handed to a carrier for shipping, finished. They are not the property of the seller now. The ownership transfers to the buyer, right? So in this case, the seller should exclude these items from its inventory, and buyer should include these items in its inventory as soon as they are shipped, even if they have not yet been received by the buyer. And let us consider an example to grasp this concept. Let's say goods have been shipped on, let's say, June 28th under FOB shipping point, right? But they arrive on July the 2nd. So what we do, even the goods have been received by the buyer on July the 2nd, but as soon as goods are shipped on June 20th, these items, even they were in transit, they will be considered as a part of the buyer's inventory, right? And the seller would exclude. So that's what it is in FOB shipping point. If the agreement is on FOB destination, so in that case, title passes to the buyer when the buyer actually receives the goods from the shipping company, right? So the goods remain the property of the seller while they are in transit. So let's take an example again to grasp the concept. Let's say if the goods shipped on June 20th under FOB destination, they arrive on July the 2nd. Under FOB destination, these items belong to the seller till 2nd of July until the goods are received by the buyer. That's important. So good would remain the seller's inventory for the period ending June 30th, and they become property of the buyer when the buyer actually receives the goods from the shipping carrier, whoever is bringing the goods. Shipment of non-conforming goods. What are non-conforming goods? These are the goods that do not match what the buyer wants, or they do not match the order or the agreement between the buyer and the seller. So when the seller ships such non-conforming goods to the buyer, the title reverts to the seller once the buyer rejects the goods. Buyer says, I don't want these goods. So as soon as he refuses, the title reverts back to the seller. This means the ownership of the goods goes back to the seller, even if the buyer physically has them. Like, consider an example. A buyer orders 100 red shirts, but he receives 100 blue shirts. So clearly this is not what is ordered. This is not what was required. So after rejecting the delivery, the title reverts back to the seller. Even though the buyer may hold these shirts with him for some time temporarily, but they are, once they are rejected, they are no longer the property of the buyer. The title, it reverts back to the seller. Next we have consigned goods. There are two parties. One is called the seller, the consigner. Other is the consignee, who is not the buyer, in fact, he is the agent. So consigner is the seller, consignee is the agent. So under this arrangement, the goods under consignment are delivered from consigner to consignee, and consignee will simply hold these goods for some time. And these goods do not belong to the consignee, these goods belong to consigner. Consigner is the owner. So consignee is just holding these goods on behalf of the consigner. So be very clear, the consigner is the owner, right? Because risk of loss stays with the consigner until the goods are sold. So consigner would include these goods in his inventory. Even these goods are laying with the consignee in his warehouse, but consigner, while reporting his inventory, consigner should include these items that are with the consignee under consignment, right? So revenue in this case is only recognized when the goods are sold to the third party. So the title then passes directly from consigner to the buyer. Next we have public warehouses. Okay, now let's say a company A Incorporated, it has used its inventory as a collateral to take some loan, and the lender has asked the inventory to be put in some public warehouse, right? So goods are stored in the public warehouse. These items which are in the public warehouse being put there as a collateral for a loan, these items belong to the incorporated companies, belongs to the original owner, right? So only is that this item of inventory is being used as a collateral, it belongs to A, right? How is the evidence shown? The evidence is shown through warehouse receipts. When these items are received in the public warehouse receipts are issued. These receipts are the proof of ownership. So this warehouse receipt is a proof of ownership, even if the company doesn't have the physical possession, but the items belong to A Incorporated, and that's what it should be included in the value of inventory of A Incorporated for the end of the period. Next, sales with a mandatory buyback. So in some financing arrangements, a seller may have to repurchase the goods from the buyer, maybe under an agreement. So in such cases, the goods which are with the buyer, still it remains as a ownership of seller's inventory, even if the title has temporarily passed. So if a buyer is holding some items which are mandatorily returnable, then these items to be considered as the inventory for seller for the end of the period. And finally, we have installment sales. If the goods are sold on installment basis, let's say A sells some goods on installment basis to B, the buyer, the legal title is with A, right? Even they have been sold on installment basis, the seller keeps the legal title as a security for the payment. If the buyer doesn't pay, then the seller can get the item back, whatever is sold. Now there are two important points that need to be remembered: situation A, situation B. Okay, so in situation A, if the uncollectible debt cannot be estimated, we don't know what is uncollectible, we cannot estimate it. In that case, the goods remain as a property of the seller, right? But if the uncollectible debts can be reasonably estimated, we have an estimate what is likely to be uncollected, in that case we recognize it as a sale, like a regular sale, and then whatever amount that is likely to be uncollectible, we create an allowance for it, right? So in this case, second case B, we recognize it as a sale, debit sale, credit receivables, and whatever of amount that is not likely to be collected, we create an allowance for that amount. We debit bad debt expense, to the income statement credit allowance for uncollectible account, whatever the amount might be, right? So this important point must be noted down. Next, we have inventory valuation. First of all, you need to know that under the US GAAP, inventory must be reported at cost. And cost means the cost incurred in bringing the inventory to their present condition and location, all the direct material, labor, variable overhead, fixed overhead, all incurred to bring the inventory in its current condition and location, that is included in cost. So this means the price that we have paid to acquire the inventory, material, labor, it's all included. These are the methods of determining inventory cost. First in, first out, FIFO. We'll discuss all these in detail, but just a little touch of what it is. So in first in, first out, the oldest items that are first in are sold first, and the remaining inventory consists of the newest item. Last in, first out, the most recently acquired items that are last in are sold first, and the older inventory remains. We'll discuss all these. Average cost, the cost of inventory is taken an average for the quarter, for the year, and this average is applied on all the items sold and the items which are in your warehouse. In the retail inventory method, this method estimates the cost of any inventory based on the relationship between cost and retail price. We will discuss this. So these are all coming. These are the methods for determining your inventory costs. Departures from the cost basis. There are certain special circumstances where inventory is not valued at cost, because we just discussed that your US GAAP requires inventory to be reported at cost, but there are certain situations where items of your inventory are not valued at cost. So these situations involve, we'll discuss precious metals, farm products, and in certain cases where the utility of goods decreases over time. So precious metals and farm products. Precious metal means gold, silver, and certain agricultural products like meat, grain. They are valued at net realizable value. And what is net realizable value? Please listen to me very carefully. An item I can sell for $100, but for selling this item for $100, I have to spend some money to complete these items. Let's say it's $20, and I have to pay a certain amount of money to make the sale in the form of sales commission, let's say $5. So this is your final selling price. This is cost to complete for short, and this is cost to sell. So your NRV is final selling price minus cost to complete and cost to sell. So $75 is what you call the net realizable value, or simply NRV, which is selling price minus disposal cost, completion cost, and selling costs. Now the question that we need to answer is that why these products have to be reported at NRV? Why? These products often have an active market with quoted prices, like for precious metals, gold and silver, they have quoted prices, right? Or maybe their cost can be difficult to track, right? So please remember, inventories are reported at NRV if in case of precious metals, there is fixed monetary value in governmental controlled market like gold and silver. It's strictly controlled by the government. Not the prices, the market is controlled by the government. The prices are determined by the force of demand and supply. And in case of agriculture or mineral products, if they meet these criteria, first, immediate marketability at quoted prices, or interchangeability means they can easily be traded for one thing for another, and third, difficulty in determining the cost, means it is hard to calculate their cost. So in such situations, what we have discussed, we would use NRV. Next departure from the cost basis is that if the utility of goods or its usefulness decreases below their cost, so a departure is needed. A departure from the cost basis is required. There are two departures. We are going to discuss them in sufficient detail. One is the cost versus market price. Whichever is lower, we will consider cost, or market price, whichever is lower. And second, cost versus NRV. Whichever of these is lower, we will take. So they apply on different situations. Okay, now let me tell you right now. In case of LIFO based cost or in case of retail method, we apply cost versus market, whichever is lower. And in all other cases, FIFO, average cost method, or whatever it may be, in that case we use cost versus NRV, whichever is lower. So we will discuss this as we proceed. For now, just take a simple example to grasp the concept. Let's say the cost of an item is $10, whereas the market price is $8. So we are going to report $2 as a loss for the period. So we recognize this loss in the current period. And in case of other methods, the cost happens to be, let's say, $1,000, whereas the NRV is, let's say, $750. So in that case, we write off $250,000 loss in the current period, right? And please note, this loss, once written off, cannot be reversed. If the NRV increases or if the market price increases, the loss cannot be reversed. GAAP doesn't allow the reversal of inventory loss. Please, this is an important point to be noted. So that's what it says. Under the US GAAP, when inventory is written down to low value, to cost, the loss must be reported in the current period, and it is a part of your CGS. But if the loss is significant, then we report it separately as a part of income statement. And this is important. US GAAP does not allow reversal. If a loss has been charged, written down, it cannot be increased back if the value of the asset or value of the inventory goes up. That's an important point. Well, this lower of cost or market or lower of cost or NRV, this rule doesn't apply in these following exceptions. First, subsequent sales price is not affected by the market price. Means, if the future selling price of the product is fixed and it is not dependent on the market value, then the lower of cost or lower of cost or market value or lower of cost or NRV, it is not applicable. Like if a product has a fixed selling price due to maybe some regulations or some agreement, the market value doesn't matter, and the company does not need to adjust inventory based on the changing market price. And second, firm sales price contract, which is similar to this one. If the company has a firm contract to sell the product at a specified price, they do not need to apply the LCM or NRV rule, right? So if the price is already included in the contract to sell at a certain price in the future, it does not need to write down the inventory, even if the market or the current market value is much lower. So these are the two exceptions to the normal LCM or NRV rule. Okay, so coming back again to lower of cost and NRV value, please remember US GAAP requires this lower of cost or NRV method when the inventory is not costed using either LIFO or, let me write it up, or the retail method. I told you this a little while ago. So other than LIFO and retail method, if inventory is not costed in the LIFO or retail method, then we use the cost and NRV. This is an important point to be noted. And what is the purpose, the rationale of doing it? Why do we need to bring it lower? We discussed it earlier. We don't want to overstate our inventory on the balance sheet, right? This method can be applied to single items, mean each item's cost versus each item's NRV separately evaluated. Categories of items means a group of similar items, the total cost of all these items versus the total NRV of all these items. Or you can apply this on total inventory, the entire stock cost versus entire stock's NRV. So any of these can be selected. So let us discuss NRV again. We talked about it a little while ago. NRV is the net realizable value. Like if you can sell an item for $100, but you need to spend some amount to complete and sell it. So what you get in the net is what you call the net realizable value, right? So NRV is basically net selling price of an item, that is minus the cost to complete and the cost to sell. Then here we talked about it. Other than LIFO and retail method, we apply lower of cost and NRV. In case of LIFO and retail method, we use lower of cost or market. So please remember, if not LIFO and retail method, then what we have? Of course, we have FIFO. We have average cost method, right? Or any other method other than LIFO and retail. So in LIFO and retail method, we use lower of cost or market. Cost means the same, LIFO and retail method. What is the market? This is sometimes mostly misunderstood by students. What exactly is the market value? So I'm not going to go for what your textbook says, market value is the ceiling or market floor. I'm not going to consider this is totally waste of effort. It will simply confuse you. I'm going to explain it in a very different way, and it's very useful. You will find it much easily understandable. So in the lower of cost of market, we take cost on the one end, and this cost has to be either LIFO based cost or the retail method cost. And then the other side, you take the designated market price. Designated market price could be any of these three. I will tell you what these are. Replacement cost, NRV, and NRV minus normal profit margin. What is replacement cost? Replacement cost is the cost to purchase the inventory item as of the valuation date. So this is the price at which the company could buy or maybe replace the item in the market. NRV we already know, and NRV minus normal profit. Normal profit is what the profit the normal company earns on it normally. So this is it. You are going to take cost on one end, the LIFO based cost or the retail method based cost, and you take these three circles on the other end. Out of these three circles, you need to select the one that is the middle number. Now listen to me very carefully. This is the critical point where students need to understand it very clearly. Let's say retail cost is $100, NRV is 80, and NRV minus normal profit margin 80 minus 10 is 70. So take the mid number. The mid number, 100 is too high, 70 is too low, so mid is 80. So you take this 80, designated market price, and you compare this 80 with the LIFO based cost. Let's say the LIFO based cost is $93. So in this case, cost versus designated market price. This is called cost or market, whichever is lower. So this is cost, retail based method cost or the LIFO based cost, and this is the designated market price, which is the middle of these three numbers. 80. So it means clearly your stock needs to be written down by $30 per unit. Now let's consider it in another way. Let's say your retail cost is 80, your NRV is 100, let's say, and your NRV minus normal profit margin is 90. In this case, the mid number out of these three, the middle number means which is neither too high nor too low. You take the middle number, 90. This middle number of these three, always these three, retail cost, NRV, and NRV minus normal profit margin. Take the mid number and compare this mid number with the cost. Let's say the cost is 90. Again, this time the loss would be $3. So please, I'm going to repeat it for the third time. In order to apply the lower of cost or market price, you take cost on one side, which has to be LIFO based cost or your retail method based cost. You compare this cost with these three and take the number which is middle of these, neither too high nor too low. The mid of these three numbers would be considered with the cost, and whichever is lower would be taken. If let's say if the mid number, let's take a new arrangements. Let's say your retail replacement cost is 120, your NRV is 110, and let's say your NRV minus normal profit margin is 100. This time our mid number, this is too high, too low, this is the mid number. So mid number 110, this is the designated market price. You compare it with the cost. This time your designated market price is higher, your cost is lower, so you keep your inventory at the lower figure because we have to take whichever these is lower. So cost is lower, we'll keep the inventory figure at $93 per unit. That's how it works. We're going to apply this concept in an extended example. Please do not go for any market floor or market ceiling. That will only confuse you. But if you wish to, I'll explain this, what this market ceiling and floor means. So let me draw that up for you. If it makes it understandable for you, fine, I have no issue. So the recommended method in your textbook is you take your cost on one side and your designated market price should not be more than ceiling and should not be less than floor. Ceiling, they call NRV as your ceiling, means your market price should not be more than NRV. And your floor is NRV minus normal profit margin. This is your floor. Now, only third element remains replacement cost. Replacement cost will only be considered a designated market price if it falls between NRV and NRV minus normal profit margin. If replacement cost goes beyond this ceiling, it is ignored. In that case, ceiling NRV would be the designated market price. If replacement cost falls below the floor, it is ignored. In that case, your floor, which is NRV minus normal profit margin, would be considered as a designated market price. So this is what is used in the textbook or in examples, but sometimes it's confusing to see the floor and the ceiling. Simple thing is just take these three together, NRV, your NRV minus normal profit margin and the replacement cost, make these three bubbles, take the mid bubble and compare it with the cost. That's how you go about it. So it's totally your choice, whichever method you find convenient. I have always recommended this method, to take the mid bubble. It's always good. You will not make mistakes. Disclosure. So when dealing with inventory valuation, disclosures are of course necessary to ensure transparency in your reporting. First disclosure, substantial and unusual losses. If there are significant or unusual losses from the changes in the value of inventory, these must be disclosed in the financial statements, right? So we don't want to deceive our shareholders, so they need to know, right? But smaller, more routine losses due to declining inventory values, they can be included in the CGS, but if there are significant substantial losses, they need to be reported. Then second disclosure is consistency principle, means the method of valuing inventory should remain same from period to period. Like if you're using LIFO, you keep on using LIFO. If you're using FIFO, you keep on using FIFO, right? If there is a change in method from FIFO to LIFO or for whatever method, this change should be disclosed in the financial statements. So if the change in this method, in this valuation method, is having a material effect on your income, then this must be clearly disclosed, because we don't want to cheat our shareholders. They need to know the whole story. LCM rule, which is applicable in case of LIFO or retail method. The following information pertains to a company's inventory at the end of the current year. The company uses LIFO and values its ending inventory using the lower of cost or market method. Okay. Calculate the lower of cost or market for the above four items. Let us first consider item 1. The cost is 20.5. NRV, selling price minus cost of completion, 25 less 1, 24. Replacement cost is given as 19. And NRV minus normal profit margin, that is 24 less 6, that is 18. So what we do, we take the mid number, neither too high nor too low. We take the number that is in between the high or low, right? This is what you call the ceiling, this is what you call the floor. And replacement cost happens to fall within this, so you're going to take this one. So replacement cost 19 versus cost 20.50. So that means this is going to be the value of our inventory. So we are going to write off a loss of about $1.5 per unit for item number 1. So here we go. It says the market price is 19 because 19 is lower than the cost of 20.5. For item 2, cost is 26, replacement cost is 20, selling price minus cost of completion 30 less 22, that is 28, and NRV minus normal profit margin, that is 28 less 7, 21. So we take the designated market price, which is neither too high nor too low, so it's the mid number. So this is the floor basically. So 21. So we compare 21 with 26. Clearly cost is more, the market price is less, so we're going to take 21 as the value for inventory. See, it says the market price 21 is lower than the cost, so therefore the inventory would be valued at $21. So for item 3, the cost is $10, replacement cost is 12, selling price 15 less 1, 14 is the NRV, and 14 less normal profit margin 3, 11 is the floor. So the mid number, neither too high nor too low. In this we have got replacement cost as the designated market price. So replacement cost versus cost, since market price is more, cost is less, so we'll keep our inventory at $10. Replacement cost 12 falls within the limit, so the cost is 10, which is less than the replacement cost. We'll keep the cost as $10. Cost of $10 is used as the value for your inventory. Item 4, cost is 40, replacement cost 55, 60 less 6, 54 is the NRV, and 54 less normal profit margin 4, 50 is the floor basically. So just in these three we find the mid number. This is too high, too low. This time NRV is the mid number, that is the designated market price. So you compare your cost with the with the designated market price NRV 54. Since market price is more, cost is less, so we'll keep the cost as is. So the item 4 would be valued at $40. Inventory is valued at $40. So inventory loss due to decline in market value is debited and inventory is credited. This loss is irreversible. Once it's charged, it cannot be reversed if the value of the inventory increases in the subsequent periods. Other than LIFO and retail method, we have another method called the lower of cost and net realizable value. So the following information pertains to a company's years end inventory. The company uses FIFO and values its inventory using the lower of cost and net realizable value. So we have two items. Calculate the lower of cost and market for the above two items. So if you just look at for item 1, our cost is 28.5, NRV is 30 less 3, 27. So we take the lower of these two. So for item 1, the lower price is 27. That would be the value of your inventory. For item 2, this is the cost, and 26 less 4. This is the NRV. Cost versus NRV, whichever is lower. In this case, NRV is higher. So we'll keep cost as is. And in item 1, we are going to revise the value for inventory from 28.5 to 27. So item 1 would be valued at the NRV 27, and item 2 would be valued at its cost. Periodic inventory system versus perpetual inventory system. There are two main systems used to track and count inventory. First one is the periodic inventory system. In this system, the quantity of inventory is determined by periodic count physically. At the end of the quarter, at the end of 6 months period, maybe at the end of the year. Usually we do it on annual basis, or maybe at the end of the accounting period, whatever the situation might be. So the actual cost of goods sold is calculated after we conduct a physical count of our inventory. So this is how it's done. This is the closing stock last year, which is the beginning inventory for the current year or current period. This is the purchases figure for the period. So that's the cost of goods available for sale. Your ending inventory through physical count comes out to be 270. So you can see your actual cost of goods sold is calculated after you get this physical count. So your cost of goods sold is 100,000. This is what you call the periodic inventory. The important part or the important concept that you need to remember is that in periodic inventory system, a running total of inventory balance is not kept. Instead, we conduct a physical count, and ending inventory is priced at the end of the period. So that's the key point here. Then we have perpetual inventory system. In perpetual inventory system, inventory record is updated continuously. With every purchase, with every sale, the inventory records are updated. That's why it's called perpetual, because it is updated with each transaction. So you can say that the actual COGS is recorded with each sale. So whenever we sell, the CGS, cost of goods sold, is updated. So you can say that the system maintains a running total of inventory balances, and every transaction updates your inventory records, and your profit is calculated after each sale. So how does it differ from periodic inventory system? In perpetual inventory system, we do not need physical count as such to calculate COGS, because every transaction of sale and purchase updates your records, and profit is calculated after every sale transaction. So in between these two systems, we have hybrid inventory systems also. So these systems basically, they just mix features from both periodic and perpetual. So in hybrid inventory systems, first we have units of inventory on hand, quantities only. So in some organizations, perpetual records is kept for quantities only. It means you have the inventory records showing you the quantity, not for the dollar value of the inventory. So you can say this is a kind of a modified perpetual system in which quantities are maintained in the inventory system, and then valuation is done later on, where the record simply is updated after each transaction, but dollar amount is not tracked continuously, right? So you may say that it's a system mix of perpetual and periodic, where we take the inventory record from perpetual, but valuation is done periodically, of course, for the dollar amount. Then we have perpetual with periodic at the year end. So some companies use a perpetual system also, and they also perform some physical inventory count, right? So this ensures that the perpetual records, whatever they are showing, actually exist in the warehouse. So this is in fact a very suitable method in which you keep your perpetual inventory records, and you print those sheets and then go and count the inventory at the warehouse. So you may do some random counts or some cyclical test counts, or maybe you can conduct complete inventory count, which you call the full physical inventory. So these are the two hybrid systems which are combination of these two. Comparison of periodic and perpetual inventory methods for sales. ABC company sold 20,000 units of inventory for 7 per unit. The inventory had originally cost $5 per unit. Prepare the journal entries to record the sale using the periodic and perpetual methods. So under the periodic method, you'll simply book sales figure, 20,000 times 7, that is 140,000 debit cash credit sales. So that's the periodic method, debit cash credit sales, 140. But in the perpetual method, in addition to the sales figure, you need to remove the item from your inventory, because remember, in perpetual system, your inventory records are updated after every transaction, right? So what you're going to do, make an additional entry. So in perpetual, that's the entry for sales, cash, debit, sales, credit 140, and now you need to remove the cost of these goods from your inventory. Remember, each item we sold had a cost of $5 times 20,000, so that is $100,000. So you debit CGS, credit inventory. So for each transaction, you see there is a gain and loss. You could see $40,000 profit here. Comparison of periodic and perpetual inventory methods for purchases. ABC company purchased 50,000 units of merchandise for $6. A unit to be held as inventory. So prepare the journal entries to record the purchase of inventory under the periodic and perpetual system. In periodic, with debit purchase, credit cash with the 50,000 times 6, $300,000, and in perpetual, with debit inventory, credit cash. So that's it. You debit your purchases, credit cash for periodic, and for perpetual, the debit is given to inventory because you need to update your inventory records in perpetual inventory system. Next, we have primary inventory cost flow assumptions. First of all, any cost flow assumption a company chooses, LIFO, FIFO, weighted average, specific identification, whatever. The key point to note is that the physical movement of goods is irrelevant. The key goal is to choose the method that best reflects the company's periodic income. That's the key point, especially when the company is selling items which are identical. So tracking exact cost with the individual item is nearly impossible. So company uses various cost flow assumptions, which we'll discuss in detail: FIFO, LIFO, average cost method. So first we have in line specific identification method. Under the specific identification method, the exact cost of each item is identified. This is only possible if your items are separately identifiable. Let me show you what it means. See, each item is separately identifiable. When units are sold, the specific cost of the units sold is added to the CGS, and items are specifically identifiable, like when you are dealing in high value items like cars or maybe expensive equipment, and these houses you can see. The cost of goods sold under the specific identification method of inventory valuation is: the items sold on March 15th were purchased on January 12th, which means these items had a cost of 2 each. And the items sold on 8th July, 500 units, they were purchased on May 5th. May 5th means at the rate of 2.2 each. See, so this way we are able to specifically identify which units are sold and what was their cost. That's what you call specific identification. $1,700, that makes D to be the correct option. Next, we have first in, first out method. In this method, the oldest costs, they are matched with current sales. In other words, your oldest costs, they go to your cost of goods sold, and your remaining inventory is valued at recent cost. This is the very key point. Please remember, in first in, first out, oldest costs become part of cost of goods sold, and your recent costs, they become part of it. In other words, you can say your ending inventory is valued at recent cost, or your remaining inventory is valued at recent cost. Now, when the prices are rising, your older, lower priced costs, they become cost of goods sold, resulting lower CGS, and recent higher prices, they become part of your closing stock. Your closing stock value would be higher. Lower CGS means your gross profit would be higher, and of course your net profit would be higher. And of course, your retained earning accordingly would be higher. And the key point further here is that current costs are not matched with the current revenues, because your older costs, they become part of goods sold. The current costs, they become part of your closing stock. During its first year of operations, Helix Corporation has purchased all of its inventory in 3 batches. Batch 1 was for 4,000 units at this rate, batch 2 was for 2,000 units at this rate, and batch 3 was for 3,000 units at 4.75 per unit. In total, 4,000 units were sold, 3,000 units after the first purchase and 1,000 units after the second purchase. It says determine the amounts of ending inventory and CGS using the FIFO method, both under periodic FIFO and perpetual FIFO. So these are your purchases in total: 4,000 at this rate, 2,000 at this rate, and 3,000. So this all gives you 40 to 50 as the goods available for sale. This just what I've marked. This is the number. Now, since we are using FIFO and FIFO periodic, so at the end of the period, we have how many? Remember, we have total 9,000 units available for sale. Of this, we have sold 4,000. That means we have 5,000 units in the ending ending inventory. 5,000 in ending inventory. First in, first out mean the units that we have sold, they go from the earliest purchase, the earliest cost. So that means the unit 5,000 which we have in the closing stock, they will entirely be composed of our recent purchases, right? So 2,000 times 4.5, 3,000 times 4.75 means the units we sold, they were sold from this. This is assumed under FIFO periodic. So that means this is the value of your ending inventory. These are the goods available for sale. From this, if you deduct the ending inventory, this gives you CGS. So this is the figure for CGS, and this is the figure for your ending inventory under FIFO periodic. Let us do the same question using FIFO perpetual, in which we will update our records after every purchase, after every sale. Let us see how it is done in FIFO perpetual. Starting first with what we bought. We bought 4,000 units at this rate. So we go 4,000 units at the rate of 4.25 each. That is the value in inventory for now. It says in total 4,000 units were sold, 3,000 units after the first purchase and 1,000 units after the second purchase. So this is the transaction now. 3,000 units after the first purchase. 3,000 units, 4.25. So that is the change in inventory reduced. So the inventory balance is this less this. That's the balance now. And this figure has been now become part of your cost of goods sold. That's right here. Batch 2, 2,000 units at 4.5 each. Here we go. 2,000 at the rate of 4.5 each. So that is the addition in inventory, and that becomes part of your new figure of inventory. This plus this is equal to this. Then it says further that 1,000 units were sold after the second purchase. First in, first out perpetual. So these 1,000 units will go out of this inventory. 4,000, 3 already gone. Now 1,000 units at 4.25. So this is the change in inventory. This less this gives you the balance in inventory, and this figure 4025 is now charged to your CGS. Batch 3, 3,000 units at the rate of 4.75 each. So if we go 3,000 units at the rate of 4.75 each, that is the addition in your inventory. This plus this gives you the balance in inventory. This is the figure to be reported as closing stock, and these two becomes part of your CGS. Now, a very important conclusion that you need to make is that whether we use the FIFO perpetual or FIFO periodic, your CGS and closing stock would always be the same. So FIFO periodic, FIFO perpetual give you exactly the same answers. See, this is the closing stock and this is the CGS under FIFO periodic. Next, we have the weighted average method. Weighted average basically assigns the same cost to each unit of inventory by calculating an average number for the whole period. So what we do, we simply take the total cost of inventory and we divide it by the total number of units available for sale. So the rate that we get is applicable to all units, right? Cost of goods sold, whatever the number of units sold, you multiply those units with this rate, and whatever the number of units remaining, you multiply those units with the rate. This gives you the ending inventory value, and that gives you CGS. So what about if there were some units in the opening stock? What you do? You do the same thing. Let's say we have 1000 units in the opening stock, valued at the rate of 4 each, so that means 4000, right? So that you will take total of this, divide by 9 plus 1, 10,000. And the rate that you get would be used to find your CGS and the value of ending inventory. Another important point that you need to remember is that this weighted average method, this is best suited for businesses with identical products. They sell similar products or identical products. So they should use this method. This, what we have done, is called the weighted average method. And remember, it's a periodic inventory method because we take all the units in a single go. We do not go for transaction by transaction the way we do in perpetual. So if we, in the same method, in the average method, if you go for each transaction separately, right, every purchase, every sale revises your unit cost, that is what you call the moving average. And that's our next topic. Here we go. We got moving average method. This method will recalculate the average cost of inventory after each purchase. Right? Let me do it. Same question. We're using the same data. So these 4,000 units at the first batch at this rate, 17,000. So the quantity is 4,000. Rate is 4.25, and that's the figure for your inventory. You sell 3,000 units. They go out of this at this cost, deducted. You get 1,000 units in closing stock at this rate, and that's the total value of closing stock. Makes sense. You purchase 2,000 again at 4.5 each. Value of these units is 9,000. This 9,000, this is interesting and notable. This 9,000 is added to this 4250, right? The total figure we'll get is divided by 1,000 plus 2,000, 3,000. This gives you the new rate 4.4176, which will be used now to value the inventory. So now you have got total 2,000 plus 1,000. 3,000 is closing stock to be valued at this rate. This is the figure for inventory. Now what happens next? You sell 1,000 units. These 1,000 units go out at this rate. This becomes your CGS. This is part of CGS. This is part of CGS. So you've got now 2,000 units to be valued at this rate. And that's the value for your closing stock. You purchase 3,000 units more at this rate. Total value of these 3,000 units is 14,250. To this add the balance 8833, which was available before this purchase. Now the total amount of these two added and divided by the units 2 plus 3, 5,000. So this gives you the new figure. This rate is used to value your inventory, and this is the rate to be used when you sell any additional units after that. So what we have, this plus this plus this, these two is your CGS, and this is the figure for your closing stock under moving average method. Next we have last in first out, or the LIFO method. Under this method, the most recent costs, that is the items purchased or produced most recently, they are transferred to cost of goods sold first. And your ending inventory includes oldest cost. The issue with LIFO is that your physical flow of goods does not generally match with the costs, of course, because normal practice is that companies prefer to sell or use their older stock first to prevent obsolescence. Of course, in bakery or in storage facilities, we tend to utilize or sell those units which are older. So nonetheless, this method requires you to use the oldest cost to inventory and the recent cost of CGS, and this is the method permissible by US GAAP, not allowed under IFRS. So if you use LIFO for your tax reporting, so it must also be used for GAAP-based financial statements. So this is what you call the LIFO conformity rule. Means if you use LIFO, it must be used both in your financial reporting as well as in your tax reporting. Now, why firms would like to use LIFO for tax reporting? The reason is that your recent costs, if they are higher, like in inflation, when the recent costs are higher, these higher costs go to CGS. Higher CGS means lower gross profit. Lower gross profit means lower net profit, and of course lower taxes payable. So there is a tendency that firms would love to use LIFO during inflationary times so as to reduce their taxes payable. Next we have LIFO layers. This is a concept which is mostly misunderstood. Let me explain first how it moves. First, imagine that at the start of the year, you have some items in your inventory. This is called your base year inventory. Let's say we have 1,000 units at the rate of 2 each, let's say. Now, from this point onwards, your inventory will either increase or decrease based on how much you sell. If you sell more units than you buy, so clearly the base year inventory will decrease. And if you buy more and sell less, then of course your next layer will be added. So what happens if you end your next year with the more inventory than the previous inventory? Let's say if your inventory now is 1200, so that means you have added 200 units more layers. So this 200 unit represent an additional layer in your inventory, right? So these layers represent the inventory you bought at different times, and of course these 200 units that might be priced at a different rate, maybe at $2.2 per unit. So when you sell items, your LIFO layers, you sell the newest layer of LIFO first. So maybe if you sell 300 units, so you will sell 200 units from the latest layer and of course 100 from the older layer. So the first items you bought stay in your inventory for the longest time, and you only sell or use them when you completely sell all the newer layers first. So this process keeps on adding layer after layer after layer at different prices. So you can say that LIFO layers are like staking boxes of products where you always take from the top box, means the latest purchase, and while the boxes underneath remaining in storage until they are needed. Layer 3 with a cost of 1.3, it would be used first to calculate your CGS, cost of goods sold. If more inventory is sold, layer 2 would be used, right? So, and maybe some units might be required from layer 1 as well. So this is how it works. Assume the same facts for Helix Corporation as in the previous example, same data we used previously. Determine the amounts of ending inventory and cost of goods sold using the LIFO method, both under perpetual and periodic system. Let us discuss this one by one. Let us do periodic method first. We have got 3 purchases, batch 1 4000 at this rate, batch 2 2000 units at this rate, and batch 3 3000 units at this rate, right? So there are 3 purchases and they are right here. First batch, second batch, third batch adds these rates. So this is the total goods available for sale. That's it. These are the numbers and these are the figure for total value goods available for sale. Now, since we are using last and first out, it's the continuation of same example. We have sold 4000 units. Since we are using last and first out, so those 4000 units means latest items will be out first. Out of these 2000, 1000 were out, so remaining means you've got 1000 units remaining at the rate of 4.5 and 4000 units at the rate of this. So this is the value of your ending inventory. So these are the goods available for sale. This is the value of ending inventory. Goods available for sale less ending inventory gives you cost of goods sold. That's what you do in LIFO periodic. Let us do now LIFO perpetual. In perpetual inventory, you will go line by line. Every purchase and sale will update your inventory record. So here we go. We've got 4000 units at this rate. So that's the inventory balance figure. Next transaction was 3000 units were sold after the first purchase. So that's the next transaction. Units sold, of course, these are the only available units. So 3000 times 4.25, 12750. That is the cost of goods sold. You sold 3000 at this cost. So that is CGS showing here. Then batch 2 was purchased for 2000 units at 4.5. 2000 at the rate of 4.5. So inventory balance goes up. Sold 1000 units after the second purchase. Now, since we are falling last in first out, so these 1000 units will be moving out of the latest purchase. So 1000 units will go out from this at 4.5 each. So that is the figure of CGS. This is the batch 3 purchase for 3000 units at the rate of 4.75, and that's the last transaction. 3000 at the rate of 4.75, so that's the figure for inventory. So what you have now, these 2 items sold at this cost, so this becomes part of your cost of goods sold. And what is not sold, it becomes your closing stock or your inventory balance. So that is the figure under LIFO perpetual. The point to note here is that periodic inventory system shows this figure for inventory and this for CGS. But in perpetual, the results are different. So the key point to remember when the prices are changing, LIFO periodic and LIFO perpetual will give different answers. That's important. So here we have the summary of all. Under periodic FIFO, you can see your ending inventory is the highest. So when prices are rising, FIFO shows the highest ending inventory and the lowest cost of goods sold, thereby the highest profit. Weighted average, on the other hand, This method averages all inventory cost and provides a middle ground between LIFO and FIFO. And when you talk about LIFO, what you see here is that LIFO gives you the lowest figure for inventory and highest figure for CGS. So when the prices are rising, COGS would be highest in LIFO, and of course your closing stock would be lowest. And in perpetual, the results are somewhat similar. It's just that the method of valuing is different, but when the prices are rising, so you see a similar pattern. CGS highest, highest. CGS lowest here, lowest. And weighted average has the same middle figure as in the moving average in perpetual. Next we have dollar value LIFO. This method basically, it's a kind of modification of your traditional LIFO inventory system, but it measures dollar values instead of units. So basically it accounts for changing price levels by using price index. We'll discuss what it is. So what's the difference between regular LIFO and dollar value? That exactly the difference. Your regular LIFO uses unit prices to calculate inventory. For example, if you have bought, let's say 100 units at the rate of 10, the value of that inventory is calculated to be $1,000. But in dollar value LIFO method, the inventory in dollar terms is measured and adjusted for inflation or changes in the price level using a price index. So let me explain how it's done. First, we compute a price index, right? That is ending inventory at current year cost, ending inventory at base year cost. So consider if your ending inventory in the current year cost, let's say $12,000. But the same inventory at base year cost $10,000, right? So the price index is going to be 1.2. So this tells us that the inventory value has increased by 20% due to inflation or some other price change. Okay, now let's say you have added $5,000 worth of goods, and let's say this $5,000 is shown in the base year cost. This $5,000 is a price for the base year. Now we will multiply this new LIFO layer by the price index 1.2. So that means it's going to be $6,000, and this $6,000 would be added to your inventory figure under the dollar value method. So that's how dollar value method. There is an extended example that will explain the idea coming to the next slide. So here we go. Internally computed price index, we just discussed a little while ago. Brock Company adopted the dollar value LIFO inventory method as of January 1st, year 1. A single inventory pool and an internally computed price index are used to compute Brock's life inventory layers. Information about Brock's dollar value inventory are as follows. All right, so what we have at the start, we have on 1st January, year 1, we've got $40,000 base year cost. All right, current year cost 40. That means there is no LIFO layer added since the base year equals the current year. What happens during year 1? So there's another layer added during the period. So now the base year cost is $45,000 with an additional $5,000 layer added at the base year cost. But the current year cost, $54,000. This is the current year value of the inventory. Now let us calculate internally computed price index. 54,000 divided by 45, 54 by 45. That gives you 1.2. This means that the prices have risen by 20% in year 1. So what we're going to do, we are going to take this base year layer, 5,000. We multiply 5,000 with the 1.2, that is 6,000. So we'll add 6,000 to this figure, and that gives you $46,000. $46,000 is the base year ending inventory. 40,000 existing plus 6,000 new layer. So this would be the closing stock figure for 31st December year 1. Comes year 2. Base year cost 60,000, including a 15,000 layer added during the period. Current value of inventory is $80,000, right? So let us calculate internally computed price index. 80,000 divided by 60,000. So that is basically 4 by 3 or simply 1.333, right? So this means that the prices have risen by 33.33% in year 2. So what we will do, we'll take this internally computed price index right? And multiply it with 15,000. That's the layer added. So that will give you 20,000. So 20,000 added to 46, this $66,000 would be the year-end to ending inventory. So finally, what is the story? The ending inventory at the end of year 1 is 46,000 after adding 6,000 LIFO layer, and the ending inventory for year 2 is 66,000 after adding 20,000 LIFO inventory. Price index supplied. So where the price index is given in the problem, then the year-end price index is simply multiplied by the LIFO layer. Let me show you how it works to calculate the LIFO layer added during the period. Walt Company adopted the dollar value LIFO inventory method as of January 1st, year 1, when its inventory was valued at $500,000. Walt's entire inventory constitutes a single pool. Using a relevant price index of 1.1, Walt determined that its December 31st year 1 inventory was $577,500 at current year cost and $525 at the base year cost. Calculate Walt's dollar value LIFO inventory at December 31st year 1. So we have the information, let's lay it down. Our base year cost, January 1st year 1, $500,000. Current year cost, $577,500. That is the value at 31st December year 1. Base year cost is $525,000. So the price index is already given. So there are some steps to follow. First, what you should do, determine the layer added at base year cost. How do you do that? Base year cost of inventory at the end of the year is $525,000. It is higher than the beginning inventory figure, so indicating a layer has been added, $25,000, right? This is the first step. Second step, calculate the current year layer using the price index. And we know the price index is given, simply multiply it with 1.1. So that gives you $27,500. That's the second step. In the third step, simply add this figure to the beginning inventory base year cost, gives you $527,500. That's the answer. Next, we have the gross profit method. This is interesting because in this method, we estimate the inventory for only interim financial statement because it is not suitable for your final financial statement for the period. So how it works? First, we need to consider our inventory available at retail price. Let's say we have inventory available at $100,000. This is the retail price, and it has added 20% profit in it. So from this retail figure, we deduct 20% of this 100,000. This would be the cost of your inventory in hand. It's a very crude method. It's just an approximation of inventory levels based on expected profit margin. So this is not used for the year-end reporting I just told you a little while ago. So let us try it, apply in a question so as to make some sense out of it. It says Dell company sells soap at a gross profit of 20%. The following figures apply to the 8 months ended August 31st year 1. Sales $200,000, beginning inventory, purchases, closing stock isn't given. It says on September 1st year 1, flood destroys all of Dell's soap inventory. Estimate the cost of destroyed inventory. So what you're going to do, apply 20% of the selling price. This gives you 40,000. 40,000 is 200,000. That's 160,000 is your CGS. We know CGS is equal to opening stock plus purchases minus closing stock. So if you simplify this equation, you get the answer. Do we have the opening stock? Yes, 100K. Do we have the purchases? Yes, 100K. Do we have the closing stock? No. So just make closing stock the subject of the equation. If closing stock is brought here, then it will be 100, 200, less than 40,000. Closing stock, 40,000. It's as simple as that. This is how the book is done. So it's too long. Just simple calculation I've shown is sufficient to find the number. Firm purchase commitments. Let's say if you have contracted a certain item at $100 per unit, and this price is fixed by under the contract, right? But the market price at the reporting date is only $80, but you are bound to pay $100. So yes, loss is expected when the purchase is made. So the loss should be recorded in the current period. So this is an important point. Under the purchase commitment, where you're bound to pay this price, if on the reporting date the price falls, then you need to bring this as a current period loss. So let's do an example to make some sense out of it. I think this is the example. It says JNS Incorporated signed timber cutting contracts in year 1 to be executed at 5 million in year 2. The market price of the rights at December 31st year 1 was only 4 million. And it is expected that the loss will occur when the contract is effected in year 2. So determine the amount that should be reported as a loss on purchase commitment at December 31st year 1. So here we go. We have a loss to be reported. So we debit the estimated loss on the purchase commitment and credit estimated liability on the purchase commitment, because we haven't yet got hold of those items. We haven't yet actually purchased them. It's an expected loss, right? So this loss needs to be recognized in the period in which the price declined. And not only you have recognized it in the financial statement, you also need to disclose it in the notes, right? A description of losses of such nature must be disclosed in the current period's income statement.